You've been saving your entire career, and now it's time to retire. Here are 3 big tax mistakes I see many retirees make. Number 1, using their 401k for everything. A lot of people know that putting money into a 401k saves taxes when you're retired, which is a great strategy. The whole problem, though, you have to remember, taking money out becomes taxable income. The thing is, when you take the money out of your 401k provider has no idea how much income tax you're actually going to owe. So almost every 401k provider out there defaults to 20%, whether or not you owe 20% or not. So if you take out $100,000 from your 401k, they're going to withhold $20,000 by default. So it's really important to make sure A, you understand what your marginal tax rates are going to be, and then B, withhold the appropriate amount. The other thing to remember is that we have a progressive tax system. This means that every dollar of income is taxed at a different rate, with the first dollars being taxed at 10% and some dollars being taxed as high as 35%. But remember, these rates only kick in once you trip certain income thresholds. As you can see on the chart here, you only trip the 22% tax bracket once you have at least $96,950 of taxable income as a married couple, or $48,475 as a single filer. So if your 401k is withholding more than you owe, you might be creating more taxable income than you need and getting a big refund. Number 2, not taking advantage of IRA to Roth conversions. So we know that money that goes into a 401k is all tax deferred. And remember, you can roll a 401k to an IRA once you're retired. But why would you do that? Having money in an IRA gives you a much broader selection of investment selections, a much broader menu of investment selections, gives you the ability to customize your withholding for every single distribution, and it gives you the ability to much more easily convert dollars from an IRA to a Roth. Now, why would you convert money from an IRA to a Roth? It's a taxable transaction to do so, but if you remember our tax brackets, you'll remember that every single dollar of incremental income gets taxed at a different rate. So if you know that in the future, you're going to have more money from a taxable income standpoint, because you might start Social Security in the future, you might start a pension, or you might have required minimum distributions from your IRA or 401k, it could make sense to do an IRA to Roth conversion now while you're in a lower tax bracket. For most people, this presents main opportunities. It reduces future required minimum distributions. Remember, a required minimum distribution is required. Whether you need to take money out of your IRA or not, you will be forced to once you hit RMD age. This is going to create more taxable income potentially than you need in the future. This creates a tax-free bucket potentially for a surviving spouse or for your kids. Remember, if you are married, you generally file taxes, married, filing jointly, which has a much more expanded marginal tax bracket than those filing single. That means if you're married today, you potentially can fit a lot more income than a single filer at the lower tax brackets. This means that if you convert now at lower rates while you're able to, if you or your spouse passes, the surviving widow or widower will have their income tax brackets cut in half, meaning they can have half as much income show up on their tax return before moving on to the next tax brackets. This is what we call the widow or widower tax penalty. In the future, that surviving spouse is going to have the same Social Security benefit from at least one of you and have the same required minimum distribution schedule based on their age. So they're going to have the same amount of income coming in the future, but much smaller tax brackets to work that through. So they could be hit with a meaningfully higher tax bill than they otherwise would be while you're both married. So taking advantage of IRA to Roth conversions while you have the opportunity can be a big benefit. Number 3, tripping the IRMAA tax, or the income related to Medicare adjustment amount. Now, if you've started taking Medicare, you might notice that your Medicare premiums go up every year, which is to be expected, but sometimes they may have gone up a lot more than you've expected in any given year. If this has ever happened to you, this is because your income from 2 years prior changed dramatically from 3 years prior. Take a look at this chart. If you're a married couple, this is how Medicare calculates your Part B premium. Now, we're looking at 2025 numbers, so this chart may be updated if you're looking at this in the future. If your income was lower than $212,000 if you were a married couple in 2023, your IRMAA premium is 0, meaning that you pay the baseline premium amount of $185. Meaning you pay the baseline premium amount of $185 per person per month. But if your income was above $212 but less than $266,000 as a married couple, you would have an additional $74 per month per person added to that premium. And if you're looking at this chart and you see that your income in 2023 fell inside one of these brackets, you probably paid an increased premium on your Medicare as compared to years prior, especially if you had a one-off income event or some other event like a large IRA distribution, sold a capital asset, real estate, you name it. Now, the good news about this chart is that this is a year-by-year calculation by the IRS, meaning that your income in 2023 impacts only your 2025 Medicare premium. Your income in 2024 impacts only your 2026 Medicare premium. So there can be reasons to have large income events, especially if they're thoughtful, knowing that you might have an increase in your Medicare, but it'll immediately go back down if your income reduces the following year. Now, this is something I've found that catches a lot of people by surprise, because they might trip one of these brackets without realizing it, and all of a sudden be caught with a meaningfully higher Medicare premium bill than they otherwise would have. But remember, this is a year-by-year calculation, so not all is lost. But this is something you need to pay attention to, because if you're planning a large income event, whether that's a capital gain, a large IRA or 401k distribution, know that it's going to change your Medicare premium if you're above age 65 in 2 years. And at the top end of the bracket, that can be pretty steep. Look at the chart again. If your income was over $500,000 as an individual, or over $750,000 as a married couple, that can be an increase of $443.90 per month, which is over $5,300 per year that you otherwise wouldn't have to pay. Now, these are just a few tax mistakes I see retirees make. The good news is, for most folks, there's still time to fix these. And with proper planning, you can get ahead of these surprises in the future. Now, if you like this video, give us a like and a subscribe, and follow along for more content.